Governor of the Reserve Bank of Australia Philip Lowe's speech last week highlighting the risks to the Chinese financial system from shadow banks, non-bank financial institutions often operating in more lightly regulated wholesale markets, has once again drawn attention to the major economic risk in China. As Lowe pointed out, most countries with rapid credit growth have a financial crisis and a recession. While China has started to recognize its credit problem and is addressing it, its responses are too late and too slow to avert a crisis. The main debate should be over when, and not if, a Chinese financial crisis will hit. The official propaganda line from China, echoed by financial market commentators keen to sell Chinese assets to investors, is that it cannot have a financial crisis because of high savings, low foreign debt, and government control over financial institutions. Yet the first to just mean that China's financial crisis will be driven by domestic markets. High savings help, but the problem is growing reliance on wholesale funding through the shadow banks. This can be measured by looking at monthly data showing the gap between deposits and loans, including disguised loans. This data shows that the Chinese financial system is still moving towards the danger zone, with a number of examples of panics already evident in China's controlled system. Government intervention after the event will not stop the recession, as the U.S. found in 2008-09 despite very quick action by then U.S. Reserve Chairman Ben Bernanke. China's road to a crisis became irreversible in 2015. While the roots of the crisis date to the 2009 stimulus in the wake of the global financial crisis, two events occurred in 2015 that make it politically impossible for Beijing to now take sufficient corrective action. First, China launched a stimulus in 2015 when it should have let growth ease off. While it is technically not too late to slacken credit growth, the 2015 stimulus means adequate action now requires monetary tightening that would probably slow GDP growth down to 2%, which is not politically acceptable. This slowdown could have been avoided if China had not undertaken the massive 2015 stimulus. Once confident about China's economic management, it took me some time to realize just how large the 2015 stimulus was, as Chinese banks and shadow banks began concealing loans on a large scale at that time to avoid regulatory scrutiny. Second, in 2015, at a major meeting of the Chinese Communist Party, President Xi Jinping elevated achieving annual GDP growth targets of around 6.5% until at least 2020 as a major political objective. Pressure on Chinese economists skeptical of the viability of this goal, together with Xi's accumulation of personal power, mean that the 6.5% targets cannot be easily questioned within China. Yet achieving these targets would create sufficient combustible material in the shadow banks to make a crisis just a matter of time. Reintroducing one-man rule in China is not only creating political tensions, but also leading to bad macroeconomic policy. While China has been blessed with experienced economic policy advisors, I have observed them being sidelined on important issues. After decades of macroeconomic stability, with strong growth and low structural inflation, China now faces something outside its recent experience. One sign of the difficulty policymakers are having coming to grips with the new situation is the focus on fixing zombie state-owned enterprises as part of the solution to financial risks. While it is a good policy, a close look at the numbers shows that zombie SOEs could not explain anything like the majority of recent credit growth in China. So in practice the focus on zombie SOEs is a distraction from addressing the real problems in shadowy financing vehicles that are quite distinct from SOEs. Chinese regulators have now begun to recognize some of the real sources of the problem. and that has driven the tighter regulation of shadow banks over the past year. However, the 2-year delay between the surge in disguised lending in 2015 and measures to contain it in 2017 shows regulators are dangerously behind the curve. As the real crisis approaches in a few years, risks will build quickly. They will not have 2 years to sort out their policies. The other weakness revealed by the current measures to contain shadow bank risk is still playing out, but should be very clear by next year. The 2017-18 regulatory tightening was, from a macroeconomic perspective, a fairly normal cyclical monetary tightening. When the housing markets weaken in the next few months and GDP growth weakens further, China will do what it always does: start a new monetary stimulus. That means goodbye regulatory tightening. The 2020 growth target will take precedence over all else. While the current regulatory tightening is welcome, it is cyclical, not structural. The only way out for China is to persist with tighter monetary policy and accept much slower GDP growth. That will not happen in the current political environment. Every time the growth target has been questioned or tested, the government has responded by reaffirming the target and stopping debate on the issue. So when will the financial crisis occur? The build-up of wholesale funding has reflected in the broad credit-to-deposit ratio for the financial system points to early next decade. The economic and political effects of this crisis, for which Xi himself will be to blame, are something Australia must prepare for. Could China find itself at the center of the next financial crisis because of its mounting debt? It marked a pivotal week that saw the U.S. government move in to save the insurance giant American International Group and issue a massive bailout to America's banks. The major U.S. indexes lost 4% of their value and long-time names on Wall Street, including Merrill Lynch, were absorbed in 2 other banks in the coming days. The contagion spread to other parts of the world and the ensuing financial crisis, sparked by a collapse in the U.S. housing market, ultimately destroyed $34.4 billion in wealth globally when equity markets hit their lowest point in March 2009, according to the Roosevelt Institute, the U.S. think tank. China did not suffer the same kind of extended malaise that plagued many of the world's economies and recovered at a much quicker pace than the United States and Europe. Much like it did during the Asian financial crisis a decade earlier, China served as a stabilizing force amid the turmoil. However, China's role in the next financial downturn may be a very different one as its level of borrowing has grown dramatically in the past decade and its economy continues to evolve, analysts said. The rapid growth in China's shadow banking system has occurred largely because the traditional banking system could not meet the strong growth in demand for funding after the global financial crisis because of regulatory constraints, the Reserve Bank of Australia said in a report in March. The Financial Stability Board estimates that entities other than banks, insurance companies, pension funds and other public financial institutions in China accounted for $9.6 trillion in assets at the end of 2016. The rating agency Standard & Poor's said that non-banks contributed to over 40% of the increase in debt in China in the years following the financial crisis and now account for more than 25% of the country's overall debt. Chinese authorities have moved to rein in shadow banking as part of an overall effort to decrease debt levels in the country following years of easy money. Henry Chan, the head of research at Caitong International Securities, said that the concerns about China's debt levels are overblown, particularly when compared with other major economies. He noted that there remains a shortage of housing in China, which has driven prices higher and led to increased debt levels rather than representing a bubble in the market. Those perverted minds who have trumpeted Chinese doom for years without success have no knowledge of supply and demand of housing, Chan said. The next debt crisis will likely happen, but not in China. It will happen when prices of crude oil, natural gas, coal rocket further. In the weeks following the Lehman bankruptcy in 2008, China had to move quickly to stave off the effects of the global slowdown as it faced one of the largest collapses in trade since the Great Depression. The Chinese government injected some 4 trillion yuan $582 billion into the economy,